So you're trying to figure out your retirement plan. Maybe you're using your favorite financial software and everything's going fine. You're entering your data, your assets, your expenses, and then it asks you what rate of return you want to assume going forward for your investments. How in the world are we supposed to answer that question? Well, that's the topic I'm going to try to tackle in today's video. I'm going to walk through some of the tools I use, how I think about that question. It's incredibly important. Even the difference of 1 or 2 percentage points, as we know, over a long period of time, can make a huge difference on any forecast. So I'm going to walk through, again, the tools I use, sort of how I think through it. I'm not saying it's the best way to do it. I think it's a reasonable way. Maybe you'll have some better ways and can leave some comments below the video with your approach. So as always, I will link to everything I show you below the video. So let's dive right in. And the first step, I think, is to recognize that you can come up with a financial plan and understand your chance of success without ever making an assumption about future returns. And I can think of at least 2 ways to do that. The first is we could just rely on historical returns. Now, of course, we have to make plenty of assumptions. We have to decide what time period we're going to look at in the past and what asset classes we're going to look at. Are we going to look at just U.S. stocks and bonds or throw in international stocks and bonds? So we have to make some assumptions, but once we make them, we can just look at the historical record. In fact, that's exactly what Bill Bengen did in his 1994 paper that gave us the 4% rule. He didn't make an assumption about returns or inflation. He just used the historical record. He went back to 1926 and he ran 51 simulations. That's what he did. And so we could do that today. In fact, we have software that can do it, and I'll show you one of them. We've looked at this many times. This is Ficalc, and I'm going to come back to this actually in our video later in this video, but that's what it does. It uses historical data. You can put in how long your retirement plan is and your portfolio balance. You can throw in your asset allocation here, at least at a high level, how much you're going to withdraw. It even gives you different withdrawal strategies. And then you can come down here and we can look at all of the different simulations it ran, going all the way back to, I think this goes back to 1871. And we can see how each of these performed over whatever duration, whatever retirement planning period we choose. So that's one way to do it. Just completely rely on the historical record. As we'll see, by the way, we'll look at a minute at the end of this video at an article that talks about how accurate or perhaps inaccurate that method is. The other thing we can do is pick a financial planning tool that just makes all the assumptions for us. Let me show you an example of that. It's Empower. It used to be called Personal Capital. This is a demo account that I've created for this YouTube channel, and you guys have probably seen it in the past. Interestingly, when I signed into this account just minutes ago, I hadn't been in the account for a while, a pop-up appeared, and it said, just perfect timing for this video, it said, hey, we have changed the way we're projecting future returns. Because what they used to do was just use historical averages, not in the same way Bill Bengen did. They would get the average return and the average volatility, and they would use those as inputs into the Monte Carlo simulation that Empower uses. But the pop-up said, hey, we're going to change that. We're now going to use Morningstar's financial model, sort of its projection of future returns. And we're sort of incorporating that into our model. And in fact, they have this article right here that walks through exactly how they do it, including here, they have a whole section on growth assumptions, including this Morningstar projected valuation adjustment that they have. And so you can, if you use Empower, you can get that information and you can dive into as much detail as you want. This is a free tool. But again, you don't have to make an assumption about future returns, and you can just let Empower, I guess now with the help of Morningstar, do it for you. And I think both reasonable approaches. There is a downside, at least to the Empower approach, and that is you got to take what they give you. You can't start to make your own assumptions in their tool. Again, I think particularly for folks that are many years away from retirement, Empower is a great tool for that purpose. I think once you get to retirement, you might use Empower, but I think a tool that will allow you to make your own assumptions can be very valuable. I use New Retirement, and that's the one I'm going to show you in a minute because they have a really important feature that a lot of retirement planning tools don't have when it comes to assumptions on growth rates. So with that then, how do we actually go about coming up with a number. And for me, the starting point is your asset allocation. What's your stock to bond allocation? And that should drive, at least as an initial matter, our assumptions about growth. And let me show you what that might look like. I'll start with a resource from Vanguard. And again, I'll link to everything. This is a page I've looked at before and had on the channel. They've changed the way it looks. But what you're seeing in this chart, they start with a 100% bond portfolio on the left, and then they increase the stock allocation by 10% with each bar, and the far right is 100% stocks. And then for each of those allocations, it shows you the best and worst years. So this goes from 1926, you can see it right here. Oops, I guess I can't do that. But from 1926 to 2022, let me see if I can make it a little bigger. Whoop, that didn't work. Here we go. All right. And so it shows you for each of those allocations, the best performing year, the worst year, and then you can see in the middle the average. And so if we'll just use, they call it 40-60 because they list the bonds first, but I would call that a 60-40 portfolio. I guess it doesn't matter. 8.6%. There you go. There's the average return from 1926 to 2022. Now, I know some of you right now are saying, wait a minute, Rob, that's history, that's great, but why in the world should we assume that same rate of return going forward? I hear you. We're going to cover that in just a minute. But I think we do need a starting point. What are we going to put in a tool like New Retirement? Because it asks for a pessimistic assumption and an optimistic assumption. So I'll show you how I do that. But I just want to show you this first data point. Before we get to New Retirement, let's look at one other source you could use for the same thing. And that's Portfolio Visualizer, a free tool. You can actually put in your portfolio here, your tickers. If you invest in VTI, which is Vanguard's total stock market, you could put that in and all your other investments. And I encourage you to try this. I will say that in my experience, what happens is you get limited amounts of data because there's going to be some fund, ETF, something in your portfolio potentially that hasn't been in existence long enough to give us a lot of data. So what I tend to do is use, instead of the portfolio here, I use asset allocation. So this just uses asset classes. So to keep it simple, I'll use US stock market and I'll use, if I use intermediate term treasuries, I'll probably get more data, but I'll try the total US bond market. So this first one would be like a VTI and the second would be like a BND if you're familiar with those tickers. We'll put in, just to keep it similar, a 60-40 portfolio. And if we run this, the first thing we want to look at is the time period. Okay, so we're going back to 87, so that's not bad. And you can see right here, we want to look at this compound annual growth rate, 8.76. So that's very close to Vanguard's 8.6. And I would probably use both of those resources. Why? We want to be careful here. We're looking from 1987 to 2024. For you stock market and inflation historians, you know that beginning in 1982, interest rates started coming down, inflation started coming down. We've kind of been in frankly, in a bond and stock bull market, really. I mean, there's obviously been some significant ups and downs, but over, the last, 30 plus years, 35 years. And so, this data wouldn't include, for example, the stock market crash of 1929 and the Depression. It's not going to include the high inflation of the 70s, right? But this data will, right? Because it goes back to 1926. Now, as it turns out, the rate of return is roughly the same, 8.6, 8.7%. And so I feel reasonably comfortable with that as sort of a starting point. Now the question becomes, what do we do with it? How do we use it? And I'm going to show you New Retirement. So what I would do, and what I do, this is how I work it, assuming that were my asset allocation, and this again is a demo account, I would go into my accounts, and we'll just use this first one. This is fairly simple. I've got a traditional IRA in this demo account and a Roth IRA, and then some money in a brokerage account. And if you edit it, you can see you can put in an optimistic rate of return and a pessimistic. So what I tend to do is for the long range historical number, 8.6, 8.7, I've rounded this up to 9. I use that for my optimistic rate of return. So in this case, 9%, you could put in 8.75. You can be more specific. But I tend to view that as the optimistic rate of return. And then I roughly cut it in half for the pessimistic rate of return. You can see this is not quite, it would have been 4.5, but the one thing I'll mention about the pessimistic rate of return, and this would be true with whatever software you use, you want to keep in mind your pessimistic inflation rate, because these are nominal, these are before inflation rates of return. If we go to assumptions and we look at inflation, so I've got general inflation at 2 to 4%. Okay, so if we go back to accounts, so in my pessimistic world, I basically have a real rate of return, an after inflation rate of return of 1%. Now, of course, we could be even more pessimistic than that, and I'll come back to that in just a minute. But at least for me, having a pessimistic rate of return that's just a smidge above my pessimistic inflation is usually what I'm aiming for. And I think that's fairly pessimistic, keeping in mind that this is a very long-term assumption. We're looking at 30, in this particular retirement scenario, 30 years. And so that would certainly be a negative, a pessimistic outcome, I think. And so that's my, at least for the initial rate of return. We're gonna get a little more, I guess, sophisticated in just a second. That's sort of my starting point. And then with new retirement, I can pick the optimistic, which would be 9% in this case. Pessimistic would be 5%, or the average, which is 2%. And I can have the software do the analysis based on that. So by putting in two numbers, I effectively get to look at three different numbers and how they affect the outcome. And it's significant. I'll show you that. But before we move away from this page, I want to mention one other thing. You may have different asset allocations in different account types. So your traditional IRA, maybe you've got a lot of bonds. And in your Roth IRA, you've got all stocks. It's important to set up your rates of return at the account level, and they very well could be different. Again, if your asset allocation is the same across all your accounts, then they would be the same. But if you have different types of investments, you want to pattern the rate of return assumptions accordingly, and that's really important, right? Because if you put a lot of bonds in your traditional IRA, it's probably not going to grow as much. You wouldn't expect it to, but that's going to affect required minimum distribution calculations, even if it's decades away. It's going to affect RMDs, and of course, in a Roth or even an HSA, a health savings account, your assumptions are going to matter because they'll dictate how much that account is expected to grow, which in turn will determine how much tax-free money you have. So it's really important to think about rate of return at the account level. But again, when we have tools like free tools like Portfolio Visualizer and this sort of cheat sheet, if you will, from Vanguard, very easy to do. All right. So I think for all of these accounts, for this demo, they're all the same, yet 9 and 5. Let's see what I put in the brokerage account, 9 and 5. So they're all the same. And so if we go to the overview, with the average assumption, that's 7%, it says I have a 78% chance of success. But if I go to optimistic, it jumps to 90. It's a big difference. And of course, if I go pessimistic, it's probably going to get ugly, under 15%. So the point is, the assumptions we make are really important to the chance of success. And what I just showed you is a really important way to think about it. Yeah, you've got to come up with a starting point for your rate of return assumption. And then with a tool like New Retirement, you can put in a pessimistic and you get an average. That's really important. This isn't just one assumption. You want to look at how sensitive the outcomes are to changes in this assumption, because we all know it's just an assumption. We know we're not going to be right. The question is going to be how wrong is our guess going to be, and time will tell, right? The other thing I'll mention is for some plans, a change in the rate of return assumption may not have a significant effect. Why? Well, you may be able to live off predominantly your guaranteed sources of income, like Social Security and pensions. And so maybe you don't have to rely a lot on your investments. And so changing the rate of return will have an effect, but it may not have a significant effect. Or maybe you're just loaded. You got so much money, you don't know what to do with it, and you're only spending 1% of your portfolio. Again, will the rate of return assumption matter? Sure. It's not going to be as significant, though. So part of the challenge here is to figure out just how sensitive your chance of success is to changes in the rate of return assumption. Again, with what I showed you in New Retirement, it's very easy to do. Now, I want to take this to the next level. And to do this, explain what I'm going to do, I want to go back to Ficalc. And what I want to do is increase our initial withdrawal from 4%, which was 40,000 out of $1 million portfolio. Let's make it 50,000. And I'm doing that, I want to come back up here for a second, because I want more failures. Before I'd made that change, it succeeded like 96 or 97% of the time. Still has a high rate of success, but it's down to 78.9. And I want to do that because I want to show you, we looked at this in the last video. The green check mark in this case means your money lasted at least 30 years. Red check mark, you ran out of money. You can click into the details to see how quickly you ran out of money, but you ran out of money. And you'll notice something, this isn't random. There are patterns here. Like, during this period, which would be from 1974, a retirement beginning in 1974, up into the present. Again, it goes to retirements beginning in 93 because we're looking at a 30-year period. All green, all good, right? And then below that, we see, boy, this is ugly. A number of years, a dozen or so years in a row where it failed. And then before that, boy, look, a lot of green. And then we come down here, we see some red. They're kind of bunched together. We could actually, by the way, if we move this to 60,000, we'll see this probably more clearly. Let's see. Yeah, we get more red. And then we get red down here in the early 1900s, late 1800s. The point is that there are patterns here. And if we can look at each of these sections with red X's, and we can see that there, some will call them regimes, economic and market regimes, where certain sort of big picture things were going on. The one that we're probably most familiar with, at least for those my age, would be this one right here. What was going on was we had high inflation in the 70s, early 80s. It triggered high interest rates. It affected the stock market, obviously affected the bond market, and it was rough for a long time. And then what followed it was the opposite, right? Falling inflation and falling interest rates. Very good for the stock market, very good for the bond market. And so the question becomes, all right, we've had good times for a while, but boy, Rob, every so often we get a whole patch of red, and it kind of feels like maybe we're due for a bunch of red X's. Yeah, I get it. Stock market valuations are high. Interest rates are still relatively low. They've obviously come up since over the last couple of years. But are we headed for trouble, at least from a retirement perspective? Now, of course, I'm not going to predict the future. I don't know, but I also believe that good times don't last forever, neither do bad times, and we do go through cycles. And I do think, I certainly wouldn't be surprised if, from a retirement perspective and how long will our money last, if things will get a little more difficult at some point in the future. And the question becomes, all right, we can hope for the best, but let's prepare for the worst. How can we model that? Well, I'm so glad you asked. It's actually easy to do in new retirement. The first thing is, conceptually, the way I think about it is, I want to assume that my first 10 to 15 years in retirement, are rough. I don't make a lot of money in the market. Maybe hopefully I don't lose over those 15 years, but it could be pretty ugly. And maybe inflation's bad. Basically a repeat of the 70s. So, but what do I put in there? What do I assume? Well, one way to do it is I'm going to go back. I'm going to make this 15 years. And of course, at 15 years, most of these succeed, right? Because it's not that long of a retirement. And I want to go to 1966. And actually, let me put this back down to 40,000. Now they'll all succeed. That doesn't really matter for what I'm going to show you, but here we go. When you click on one, you get a lot of great data. By the way, you can, if you download a CSV file, spreadsheet file, you get even more data. But what I want to show you is, for this 15-year period, we can scroll down, and here we go. Market data, stocks, their geometric mean, which is just a fancy way of saying their returns. Technically, their compound annual growth rate, but it's the same thing that we see over here, right here, compound annual growth rate. Same thing. It's called a geometric mean. Over this time period was 0%. I'm sure there's some rounding, but 0%. Bonds, 0%. There were, some mathematical averages were different, but basically over that period of time, your money didn't really do anything. Although inflation, yikes, between 6 and 7, closer to 7%. So we could use some of this to model a bad sequence of returns risk in new retirement. How would we do it? Well, I'm going to come over here and I created you can create scenarios. I created what I call the danger zone scenario. I want to make sure I've got things the same. I think I do. Let me go back to the baseline for just a second. Yeah, I do. Okay. So what we can do for the danger zone, we can make some changes. And one of the things that I did, I don't remember if I did it quite the same way. Yeah. So you can, I'll delete this and then show you how I did it. You can model a rate change in the future. So what I did for the first 15 years, I'm just going to assume a 0%. I put 0% as both optimistic and pessimistic. So it doesn't matter which assumption I choose, or even if I choose average, I'm going to have no return. And I'm going to have this go, in this model, I'm 65. So let's have this go till I'm 75. And then what's going to happen? Well, I'm going to go back to my 9% and my 5%. So I've just modeled a sequence of returns risk. Of course, you could put anything you want here. You can change at what age it changes. By the way, if you're many years away from retirement, you could use this to model change in your asset allocation, right? So a lot of different uses for this. And you want to make sure you do it. Let me save it. And then let's see what I did here. Yeah, I did the same thing here. So that's good. And then I don't think I did it for the brokerage account. Model a rate change. So again, we'll go to 75. And we'll change this to 0. So the idea is this will be our rate of return. The future rate change will be when I'm 75, and it'll become this optimistic and pessimistic. Now on assumptions, I've got general rate of inflation, but what I can do if I want is change that for this danger zone. But I'm going to leave it the way it is for now. I could assume a higher pessimistic. We could, why not? Put it in. We'll put in 7% for pessimistic. There we go. I don't think there's a way to model changes in inflation rates, but I don't think so, but I could be wrong about that. In any event, so we've put in sort of all this ugliness. So what happens to our plan? Well, optimistic, 50%. Okay, now let's think about this. We're assuming 0 returns for the first 10 years, but we're assuming low inflation. By the way, on the assumptions, you know what we can do? We can actually flip. I know we don't think of optimistic inflation as high and pessimistic as low, but there's no reason you can't do that. So that now, when you use optimistic, you're actually using a 7% rate of inflation. And you can see, yikes, under 15%. So now if we go to pessimistic, still under 15%. But of course, we're assuming a lot of gloom and doom. What we can now do, by the way, is okay, this is worst case scenario. Let's go to average, just for the sake of, it's still going to be under 15%. We can start to ask questions. Well, if this really did happen, I hope it doesn't, but if it did, what can I do? Well, you can go to your expenses. What if I cut back my expenses? And to what extent you can do that, obviously, is going to depend on your specific circumstances. But what if you said, well, if I had to, I could go down to $5,000 on my expenses. What's that do to my plan? It gets me up to 36% with average, gets me up to, oh, that's right, optimistic is really not that optimistic because of the inflation rate. That's still not good. Pessimistic is 99%. So again, the difference there being lower inflation. And you could even then play with the inflation numbers. You could say, well, okay, 7%. I don't think the Fed's going to let it get that crazy, but we'll assume 5% optimistic. And again, I'm pairing that optimistic that way because of the changes in the rate of return assumptions that I'm making. That's 36%, but that's still with a pretty high rate of inflation and 0 returns for a decade. And so you can obviously put in whatever assumptions you want. You can create multiple scenarios that look at this danger zone, right? And you can even compare them side by side. I know I did that quickly. Let me back up. You can come down here to scenarios. That brings you to this page. You can then compare scenarios, and we can compare baseline to the danger zone, and you compare them, and it compares all your numbers, your net worth at the end of the plan, net worth at retirement, chance of success. So a lot of different ways to compare. It compares your taxes. So it can be very, very useful to run different scenarios. So I know I've kind of gone through a lot of it and somewhat quickly, I guess, but that's how I think through rate of returns assumptions. That's how I get sort of my initial assumption, how I entered in new retirement to show pessimistic and optimistic. One way to use to model a change in the rate of return at some point in retirement. Now I mentioned I was going to talk about, well, is there any of these ways better or worse than others? Well, there was an article on Michael Kitz's site. He didn't write it, but it's an article on his site. Here it is. I'll leave a link to it. What was interesting is they found that there were two particular ways to try to model all of this. That if you went back in time and sort of judged them to see how things turned out, did better than even just straight up Monte Carlo analysis. What were they? Well, the first is just using historical returns, just like Ficalc does. This actually, so far anyway, it's turned out to be a good way to simulate returns and to get predictive value from it. And the other way is these different regimes that we looked at, where we change. We don't just have one assumption for rate of return throughout all of retirement, but like the danger zone, and I'll go back to it here, scenario, we have one rate of return for like the first 10 or 15 years of retirement. They call it regime. They use that same word. And then a different one going forward. What you would have for that first 10 or 15 years is in large part based on the current market valuations. They're so high, it probably makes sense to assume lower returns over the next decade. And by the way, we assumed 0, That was really just for purposes of this video so that I could keep the variables to a limit. What I would probably do is not have it at 0. Maybe I'd have it at 4. Whoops, not 400. At 4, pessimistic at 0. If I did that, I would come back to assumptions, and I would change this around maybe to 2 and back to 5. And then that way, when I was actually looking at different optimistic, average, and pessimistic, I would indeed get different answers. And there you go. I don't know why the pessimistic is actually 99%. I think I've probably put something in incorrectly, but it's got to be with my assumptions. This went back to 2%. I must have done that by accident. There we go. It's better, under 15%. Now I feel good about it. Well, there you go. If you stayed with me this long, you really deserve a medal. Anyway, that's how I think about figuring out the rate of return assumption in my plan, how I use historical simulations with Ficalc. In new retirement, I like to use a change in assumptions at some point in my retirement to sort of model sequence of returns risk and to play with assumptions like inflation, just to see how small changes either do or don't affect the chance of success of my plan. Hope that helps you. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.